Alright, I wanted to do this video pre-market so the options didn't move and the price didn't move because I wanted to talk about my 1% and implied volatility. Let's look at PLTR. This has been a favorite lately. It's been pushing 15. Can't quite get over it. It's at 1471. Let's look at this week's options. These expire in about 2 days. Let's look at the first in the money is at 1450 and the first out of money is 14 on the put side. Now, implied volatility, that's why these premiums are so high. It's already baked in that this stock is going to move and we don't know where it's going to stop. That's why they're paying $60 premium on a $14 stock and $14.50 stock, and then $38 premium on 14 right here. Now, what I mean by my 1% is I got to put up $1,400 if I want to buy this, if I want to promise to buy this or sell a put. I got to put in $1,400. For that money, for that $1,400, I want 1% back. That's $14. Now, this may not sound like much. You may want to go for this high premium, but think about it this way. This is in a week or less than a week. If you make 1% a week on your money, that's 52%. Now, you don't want to put up all your money. If you even put up 50% or put 50% to work and 50% cash, that's still 25%. So that's why I shoot for the 1%, because I want to pull back. I want to pull back all the way to this 13. So if I put in 1,300, I could possibly get $13 on the open. And then the stock would have to move an entire $2 in order for that to trigger. Almost an entire $2. So that is a massive move. That's a 15% move. Now, I'd be comfortable with a 15% move for the 1%. Because that is a massive move. Now, it still could happen, but that puts me more out of danger. Because if I trigger this at 14, sure, I collect the 38, but this could move to all the way to 12 tomorrow, or all the way to 13, which I would lose $1 a share. Not really worth the 38. Not really worth the $38. So that's why I stick with the 1%. Now let's look at something with a little lower implied volatility, a little more up my alley, because I like to collect premium. I don't like to buy stock. Okay, that's the difference. But I'm okay buying this stock. This Conagra Food Brands, very solid stock, but it doesn't move much. Not a lot of implied volatility. See at 35, the first in the money, that's a full 70 cents away, and that reflects the 70 cents right here. The 70 cents is built in. And then at 34, which is only 30 cents away, it'll only pay you 10. So this has almost zero implied volatility. It's almost trading, the options are almost trading the exact amount that it is away from the strike price. This is 70 cents away from the strike price, and the 70 is right there. You may get a bump at 80, you may get a fill at 80, but that's all you're making. That's not near my 1%. That's why I have to play levels. That's why you look at the levels, because when they start reaching levels, you know that makes the strike price a little more certain, right? Because I don't know what 35 means when I'm talking about Conagra brands. That's why I have to look right here. 35 is not a level. 35 is right here. That's not a level. So it could hit it. I have no probability that it will or will not hit that 35. Now, I'd be more comfortable at a 34 level. 34 here is a little better level, but still better is the 33 level, because look, right here it was a resistance, right here it was support, right here it was support. So that 33 level is a little more comfortable. So when it starts dropping all the way down to 33, these options will start getting a little more juicier, and it would be more comfortable owning them at 33, knowing that there's a very good possibility that it'll bounce off that 33. So that's how I talk about my 1%, the implied volatility, the levels. That's just some of my analysis.